We'll look now at the very different banking reform process in the US, where the emphasis is on making the banks keep enough capital to bolster them against bad times. I asked Mark Bloomfield of the think tank, the American Council for Capital Formation, what he thought of the British Chancellor's proposals.
Well, as you know, it's a very complicated matter, and the details are hard to even obtain now. But having said this, I would like to make 2 points. One, I think the approach of the Chancellor is quite draconian. And I say it's draconian because he has 3 choices. One choice is to restore what we call Glass-Steagall, which is to have that separation. The second is to do nothing, which is unacceptable. And the third is to do what we did, which is the Volcker Rule. And the basic difference between our approach and that of the Chancellor's is markets today have outpaced regulation. The better approach is to modernize the regulation than go back to outdated markets. In other words, our approach, known by the 2 authors, Senator Dodd and Chairman Frank, were to modernize the regulations and not restore Glass-Steagall.
So modernize in what way?
Well, modernizing through transparency. I think the major issue now, of course, is capital requirements. And as you know, the FSB, working with the G20, have come up with capital requirements, which are controversial. But it seems to me that that is focusing more on regulation than trying to ignore the fundamental changes in markets, which have helped our economies grow.
Well, let's descale that so people can understand. What you're saying is that by having large capital amounts that banks and financial institutions have to keep there as reserves, if you like, that will avoid the situation where banks have to be supported by the state, which is what's happened in the past.
Well, that is probably the most important thing to do right now. Having said that, we're not in a neutral economic environment. If the capital requirements are too high, we risk falling back into a double-dip recession. In other words, as you know, the international requirements suggested now are 7%. Our banks, at least the U.S. banks, have higher capital reserves than they did before the financial crisis. But as you may also know, under Basel III, we have a possibility of a 3% surtax on capital requirements, 3% extra capital requirements. And I fear without adequate scrutiny, we could risk going too far.
But you're talking here about capital requirements. You've completely put out of the window the suggestion that there should be regulation that actually says if I put my dollar in the bank, I have to know that that dollar isn't going to be put into dodgy derivatives and could be lost in what the bank does with it.
Well, again, you don't have to do it by arbitrarily separating the evolution of financial markets, which have allowed for more credit to be available for businesses and individuals. For example, in the United States, we have not gone back to Glass-Steagall, which is make that arbitrary, rough, draconian distinction, but we insure depositors for a large amount, so their loans are fully insured up to a certain amount.
What you're saying is what the United States has been doing, what you've been outlining, is enough. It should be plenty to make sure you never again have banks that are too big to fail.
No, I'm not saying that because, number one, we cannot do it alone, and I think given the global economy, so we have to harmonize our capital requirements with those of the rest of the world. Because what happens if somebody sneezes here, we could have an earthquake in Bulgaria or even in Panama. So harmonization, first of all, of capital requirements is important, and also harmonization of other things like the resolution of bankrupt entities. But we don't want to, on the other hand, deal with moral hazard where we assure that companies can always be bailed out by the government.
Mark Bloomfield of the American Council for Capital Formation.